The video clarity, audio quality, everything is proper. So let's discuss audit of banks. Just hardly 40 minutes. This topic will be over 40-45 minutes. I will tell you the main theme of this particular topic. Hope everything is clear. Kindly just confirm me once. Yeah, perfect. Perfect. So let's directly proceed discussing this bank audit topic. So audit of banks. In this, I figured out 8 concepts which are very important. 1. Various reports which a central statutory auditor or statutory central auditor has to give. What are the various reports? How to appoint the auditor of a bank? What are the various contents of audit report in case of a bank? And how to do audit of advances given by the bank? NPA norms, drawing power calculation, sanction limit means what, drawing power means what, how to calculate drawing power, and how to do audit of income and reversal of income, how to do audit of expenditure. If these points, if you're clear, bank audit is over. Hardly we will be spending another 40-45 minutes on this particular topic. See the kind of clarity that you're going to get. Amazing clarity I'll give you in this particular topic. Now, audit of banks. Okay, inside this, mainly I will discuss important points. What are the additional reports by statutory central auditor? Those of you, I have already taken something called SBI example. 12 joint auditors will be there. 6,000 branches audit were done in SBI. When I'm discussing other matter paragraph in audit report topic, I discussed. So banks will have something called central auditors, principal auditors, and branch auditors. Principal auditors are called as statutory central auditors. Branch auditors are called as simply statutory auditor. In a bank and insurance company, SA means statutory auditor, means generally branch auditor. SCA, statutory central auditor, means principal auditors of a bank. So that's what the main meaning. Now, so what are various reports? See, first of course, they will give audit report. Apart from audit report, what are various reports which a bank auditors will give? I report on adequacy and operating effectiveness of internal controls. Okay, so this is annexed to the main audit report. So a report on IFCO for internal financial controls over financial reporting and their operating effectiveness. That is one report. Long form audit report. Bank auditors will also give one more report called long form audit report. SLR, statutory liquidity ratio. Banks have to maintain 2 reserve ratios, cash reserve ratio, statutory liquidity ratio. So whether they are complying with those ratios or not, the auditor has to give a report on that. The auditor has to give a report on IRAC norms, IRAC, income recognition, asset classification norms. Whether the bank has complied with IRAC or not, the auditor has to give a report. The auditor shall also give a report on adverse credit deposit ratio. One time they have asked one MCQ. Here they removed the word deposit and they put the word credit. Adverse credit lending ratio. They mentioned lending. Lending is wrong. Deposit ratio. Credit means lending, deposit means bank accepting deposit, lending. So lending to deposit ratio, that is right word, be clear. So that's it. So these 5 points you write. In exam they may ask you, what are various other reports which a central statutory auditor of a bank shall give? These are the various reports the statutory auditor has to give. Apart from that, Ghosh committee report, Jilani committee report is there. Ghosh committee report is dealing with frauds and malpractices. Jilani committee report is dealing with controls and inspection. Internal controls and inspection of systems. That's it. Then, there are various types of banks. Non-computerized banks, right now nothing is there in India like that. Is there right now? What are all the banks that we see in and around in India are fully computerized banks. Fully computerized banks, they use something called core banking system, where all the branches are interconnected so that customers can access services from any branch of the bank. So auditor must ensure that RBI norms are incorporated in the computer system so that proper classification, provisioning, everything will be done. Auditor should exercise judgment, professional skepticism, and prudence to validate system generate time to process. Higher productivity, lower productivity. Simple. Okay. Now, audit plan and what points the auditor has to consider. Just 1 minute. Yeah, I think proper. It is proper. Yes, it is proper now. Yes, look at now. audit plan and points to be considered. What are the points to be considered in a bank? So when you're developing an audit plan in a bank, you should consider the nature and level of operation. You should consider what are the adverse features. You should also compare what is the level of compliance based on previous reports. Evaluate risks identified due to IFC and breaches and all that. So this is a very basic point. Control environment in a bank. What are the control environment in a bank? Control environment. Segregation of duties. This itself can be directly asked as a 4 marks question. Write about control environment in a bank. They may ask you this itself as a straight question. Segregation of duties like front office and back office. Accurate measurement and reporting of positions like cash balances, all that. Proper verification and approval of transactions. Regular reconciliation of positions and results. Setting appropriate limits for activities. Timely reporting and approval of exceptions. In this any 4 points. Control environment, any 4 points. Physical security and contingency planning. This point is not relevant. Procedure for conducting bank audit is also not relevant. It's not that important at all. Then here no. Reliance on others reports. 8th point. Very important for 4 marks question. One time it was asked. When we are conducting bank audit, the auditor will review other reports for identifying adverse comments, whether anybody else have made adverse comments on the bank. For that reason, various others report and all the auditor, stat auditor wants. For example, internal audit report, concurrent audit report, manager's change report, manager's charge, when a manager is taking a charge, that report, handing over report, and RBI inspection report, internal reports, previous auditor's report, security verification reports, various reports the auditor will go through in order to, when he's planning the audit, he will go through other people's reports like this to identify whether they made any adverse comments like that. So this itself was asked as a 4 marks question once, so be careful. Next, appointment by the auditor. So Companies Act, qualifications, disqualifications, everything is as per Companies Act only. Further, who will appoint the auditor? Normally for regional rural banks, board of directors will appoint after taking approval from central government. For State Bank of India, COG will appoint, C&AG will appoint. Okay, subsidiary auditors are appointed directly by State Bank of India itself. SBI has some subsidiaries. Their auditors will be appointed directly by SBI. Remaining nationalized banks, other than SBI, remaining nationalized banks, directors of the bank will appoint with RBI approval. Then all other banking companies, means these here all private banks and all covered. For them, auditor will be appointed by shareholders at AGM with RBI approval. So first this you should read, then you should read this, then you should read this, at last you should read this banks. So RRBs, SBI, other nationalized banks, remaining banks, means private banks and all, shareholders will appoint in the AGM, provided again the auditor which auditor will be recommended in the AGM, RBI will approve the auditor, that auditor will be recommended in the AGM. Next, remuneration. It is fixed under Companies Act only, 142 section. In a general meeting, in case of nationalized banks and State Bank and RRB, central government and RBI will together fix the remuneration. The powers of the auditors are same like company auditors under Companies Act. Reporting. So to whom auditor has to report? Reporting to central government. For nationalized banks, auditors has to report to central government. In that audit report, in other report on legal and regulatory requirements, there is a para in audit report, there is a section in audit report, report on other legal and regulatory requirements. Under that, the statutory auditor has to comment on true and fair view, whether the balance sheet and P&L are the present in true and fair view, he need to give a report. Whether explanations, information, so the stat auditor will be asking so much of information, whether he is getting proper information or not. Ensure that transactions are within the powers of the bank, and verify branch returns, are they adequate for the purpose of audit. He need to comment on all this. And format of audit report, same SCI 700 format only the audit report will be there. And in the audit report, quantification of advances, deposits, interest income, interest expenditure for unaudited branches must be given. In other matter paragraph, I already showed this when I'm discussing quantification. So the auditor has to tell how many branches are unaudited. Some 20,000 branches are unaudited. Okay, 20,000 branches are unaudited. What is the quantification? 30%. These 20,000 branches will occupy 30% of interest income, 25% of interest expenditure, 40% of advances, 35% of deposits. Like this, you should give a specific quantification. Okay, then report must comply with 143, and CARO is not applicable for a banking company. Be careful. So format of audit report, this itself can be asked as a 4 marks question. Be careful. long form audit report. Further, for banks, the auditor shall give, in addition to a normal audit report, the auditor shall also give something called long form audit report. So yes, everybody, I recommend you to watch at normal speed or reduce the playback speed. Since it's a revision, I'll be discussing little faster, so you either watch at normal speed or reduce the speed. Why are you hurrying? I'm already covering it in a super fast, so you please watch at normal speed or watch at a lesser speed. Long form audit report, for all banks, public banker, private banker, foreign banker, doesn't matter, the auditor must submit something called long form audit report. This is something like a caro only. Okay, matters for long form audit report. What are the matters in the long form audit report? What points will be there? RBI will decide. Long form audit report must be submitted by 30th June annually. So for example, financial year 24-25, March 2025 is the closing date. 30th June 2025. Next, proper planning. So even for LFAR also, you must do a proper planning so that you can submit on a timely basis. Executive summary. For LFAR, can you give a summary of LFAR? Yes, you can give, but that is optional, but recommended for key observations. So executive summary in LFAR is optional, it's not mandatory. For MCQ it might be important. And finally, auditor must report fraudulent activities or suspicious transactions to RBI, very important. And further, if auditor identified any fraud which is more than 1 crore, automatically 143 subsection 12 is applicable. In addition to reporting to RBI, auditors appointed under 139 means stat auditors, they should also report to central government if at all they identify any fraud where the amount involved is 1 crore and above. 143 subsection 12, that's it. So this is regarding reporting of frauds. Then now finally the most important, now you see what are the points that we covered. Various reports, stat auditors has to give completed, auditors appointment we completed, audit report content we completed. Now we are going to discuss about audit of advances. What are various advances? Advances is the one which is major asset in a bank. What are the major assets of a bank? Advances. Major liabilities of a bank? Deposits. Okay, so examination of advance, most important. Large advance 100% you should verify, remaining advances on a sample basis. Sir, what is a large advance? An advance is considered as a large advance if the year-end balance is more than 10 crore. If the year-end balance of the advance is more than 10 crore, automatically it is considered as a large advance, or it is 10 crore. That is one limit. Sir, advance amount is less than 10 crore, sir. Can I straight away call it a small advance? No. Compare with another number. Is it minimum 10% of the aggregate year-end advance of the branch? Check out. Suppose, sir, there is one branch, sir. For example, Chennai State Bank of India, one branch is there, sir. In this branch, total advances as on 31st March from all customers. Total advances from all the customers 31st March, let us assume that is 100 crore. No, not even 100 crore, sorry. 20 crore only. 20 crore only. Now, in 20 crore, right? So, what is the large advance? Total outstanding balance with one customer is 10 crore, or it is more than 10% of the branch outstanding. Branch outstanding 20 into 10%. Oh, 2 crore. If one of the housing loan customer is there, sir, 3 crore outstanding amount is there. In this branch, total advance value itself is 20 crore. Into 10% 2. Housing loan customer 3. Even though it is less than 10 crore, for that branch, it's a large advance. So whether an advance is a large advance or not, one limit is 10 crore limit. If the amount is not exceeding 10 crore, it is less than 10 crore, then compare with the 10% of the branch outstanding, total outstanding. If it is, suppose if a particular loan to a particular customer, an outstanding loan from a particular customer, an advance from a particular customer is more than 10% of the total branch outstanding as on 31st March, then that is also treated as a large advance. So that's it. Whichever is less, that's why either 10 crore or 10% of the total branch outstanding as on 31st March, whichever is less, that itself is treated as what? Large advance. Large advances we do verify 100% in our audit, whereas remaining advances we verify on a sampling basis. And again, advances are two types in a bank. Funded advances, non-funded. For example, I gave a guarantee. Bank gave a guarantee on to a customer, to third party on behalf of one of their customer. There is no fund transferred, so that's a non-funded. Okay, no actual fund transfer like letter of credit, bank guarantees, all that. Funded means what? Term loan, cash credit, OD, all these are funded. Means funds transfer will be there. In a loan agreement, if a fund is transferred, that's a funded loan. Remember, you have caro, right? In caro, working capital limit point is there, right? Clause number 2, second clause, inventory. Inside that working capital point is there, right? Sanction limit 5 crore is there, right? There, funded, non-funded, both you must consider for checking whether total advances is 2 crore crossed or not. And remember, advances can comprise term loans, all this. Bank has to disclose advances in the following way: bills purchased and discounted, how much; cash credit OD, how much; term loans, how much. Further, loans and advances given by banks is again subclassified into secured, covered by guarantee, unsecured, how much. Again, loans given is categorized into two parts: outside India, how much; inside India, how much. Inside India, priority sector, public sector, banks, others. To breakup you should give like that. Advances outside India, due from banks, due from others, how much, like that. So this disclosure requirement might be important for MCQ purpose. Remember, this disclosure requirement might be relevant for MCQ purpose. Be careful. Next, then classification of advances based on security. Bank will accept two types of security. Nature of security, two types: primary security, collateral security. Primary security is the principal security offered by the borrower. Suppose I am buying a housing loan. I want to buy a house. For that I want to get a loan. The house itself is given as a loan. That's a primary security. Banker told me, sir, this house alone is not sufficient, sir. I want extra security also. Tomorrow if this house value is declined suddenly, I want extra security. Then the person gave his car as a security, as a second collateral. That's additional security provided by the borrower. On collateral security, bank will not have any right initially. If primary security fails, then only collateral security bank will exercise. Then what are various common securities which a bank will accept? Goods, gold ornaments, immovable property, plantation, LIC, life insurance policies, stock exchange securities. Any of this can be given as a security. Again, how to create a security, mode of creating the security. One is mortgage. If immovable property is given as a security to a bank, that's called as a mortgage. Mortgage is two types: registered mortgage, equitable mortgage. Equitable mortgage is there in the informal lending sector, like where ownership documents will be given to the bank, and then that's how mortgage is created. I will just give ownership documents to the bank. In a registered mortgage, we will go to register office and register the mortgage deed with the bank. So that's the registered mortgage is powerful, remember. So in an equitable mortgage, title deeds will be given to him and he will give a loan, but keeping the title deeds with him. That's not secure. Okay, registered, created using a registered instrument which is signed by mortgager, mortgagee, both. Pledge, gold loan is best example for pledge. Bailment or delivery of goods will happen. Ownership remains with the pledger. Hypothecation, ownership and possession remain with the borrower, who acts like a, for example, house, vehicle loans, bike loan, car loan. Yes or no? Here, no, bike loan you are getting, car loan you are getting, car will be with you only, no. That's called hypothecation. Okay, pledge and hypothecation both are on movable items. In pledge, goods will be given to the banker. In hypothecation, goods will be with you. OD, overdraft, cash credit, inventory loans, these are all working capital loans, generally in the form of hypothecation. Okay, and in hypothecation, borrower will submit periodically statements, assets and liabilities, assets, stock statement, debtor statement, to determine drawing power. Sir, what is drawing power? We will discuss that later. Assignment, LIC policy. Suppose I want to get a loan from a bank. I have an insurance policy. It has a surrender value of 2 crores. If I surrender the policy right now, I'll get 2 crore money, which means I have 2 crore worth of asset right now. I gave this policy to a banker and I got 1.5 crore loan. The policy I will assign it to the banker. So that's called assignment. So transfer existing or future debt, my receivable, my right, I will transfer to banker. Only actionable claims are accepted by banks. Set off is not a popular method, very rare. Generally, for example, I want to get a credit card. I don't have a credit score at all. My credit score and all is not, banker is not trusting me at all. So I did one thing. I gave 1 lakh fixed deposit. Then I got 75,000 rupees worth of credit limit credit card. Tomorrow if I don't pay, this credit card liability will be set off with that FD. So set off is not a security basically. But here in set off, in set off technique, it will enable bank to combine two accounts. Okay, deposit account and loan account. I have a credit card which is a loan account. I also have a FD with the banker. So accounts must be in the same name and same capacity. Right of set off applies to time barred debts also. All branches will be treated as one for the purpose of set off. That's it. Lien is not at all a mode of creating security. I don't believe it. That's not correct at all. Okay, fine. Next. So now we completed one more point. Audit of advances point we completed. Now let us discuss about prudential norms, especially NPA norms. So classification of advances as per prudential. There is something called RBI prudential norms. As per RBI prudential norms, the loans and advances are broadly classified into two types: standard loans, NPA loans. Standard loans are nothing but standard regular. Regular means what? These are the assets where there is no stress signal at all. No stress signal. The standard accounts are again classified into another type, SMEs, special mention account. SMA 0, SMA 1, SMA 2. SMA 1, accounts where some stress signal is there. SMA 1, sir, I gave a loan, sir, customer defaulted. EMI due date came, he defaulted. Is the default more than 90 days now? Is overdue more than 90 days? No. Overdue is just between 30 days to 60 days. Overdue is between 60 days to 90 days. Then SMA 2, that is called as what? That is called as what? SMA 2, you see, SMA. So SMA 1, overdue between 30 days to 60 days. SMA 2, overdue between 60 days to 90 days. Or if an account is showing some stress, we can straight away classify it as SMA 0. Now, so that's it. These are all special mention accounts, standard accounts. These are all standard loans. Suppose if there is a default, and the default is more than 90 days, straight away that loan will be classified under NPA category. NPA category is again subclassified into three types: substandard, doubtful, loss. NPAs are again classified into three types: substandard, doubtful, loss. Now let's look at what is an NPA exactly. When a loan is treated as an NPA, just 1 minute. Yeah, it's okay, just 1 minute. Yeah, so when a loan is treated as an NPA, an asset becomes NPA when it stops generating income. Asset performing means what? It is giving me income. Non-performing is what? It is not generating income. That's it. An asset which stops generating income is called as NPA. So how to decide whether a loan is an NPA? For term loans, no, interest amount or principal amount or both, installment amount overdue for more than 90 days. If a term loan is overdue for more than 90 days, it's an NPA. Bills, if a bill is overdue for more than 90 days, then also it's an NPA. Whereas for cash, credit and OD, the account is out of order. If the account is in out of order in a cash, credit and overdraft, then that straight away is treated as NPA. Out of order means what? Many a times it was asked, what do you mean by out of order? An OD account or cash credit account is treated as out of order if outstanding balance in the OD account, outstanding balance in the cash credit account is exceeding sanctioned limit or exceeding drawing power continuously. What is this? What is this outstanding balance exceeding sanction limit drawing power? What exactly that means? You know, there is something called sanction limit drawing power. Sanction limit is given, sanction limit is decided based on repayment capacity of borrower, whereas drawing power is decided based on value of security given by borrower. You know, a bank will give loan based on two criteria. One, whether a customer has a repayment capacity. That is the most important. Okay, this is the most important. Two, okay, he has a repayment capacity. What surety I'm getting? What security I'm getting? That is also important. Suppose, no, customer can repay 10 crore within 1 year. Suppose the customer have a repayment capacity of 10 crore. Then the bank will sanction 10 crore loan, but they will not release 10 crore money. Okay, 10 crore you can take, I will give 10 crore loan, you can take, no problem. But if I have to give 10 crore worth of loan, give me 20% extra security. For example, 12 crore, you give me 12 crore worth of land, 12 crore worth of jewelry, 12 crore worth of asset security. Then I will release 10 crore fund. Customer know what he did, you worth of asset only. Security value is 8 crore only he gave. Oh, he gave 8 crores only. 20% I will eliminate. Balance approximately some 6.5 crore. Only this much I will release money. Only this much I will allow the customer to withdraw. 20% margin I will maintain. Example, I'm just telling you. Getting it? So if you want to draw 10 crore, you give me 12 crore worth of security. If you want to draw 8 crore, give me 9.6 crore worth of security. So this is what the condition I put. So if a customer is giving 8 crore worth of security, I will eliminate 20%. Balance amount only I will give him for withdrawal purpose. So that is drawing power. So drawing power is decided based on the value of security given by the customer. Sanction limit is decided based on the repayment capacity. A OD account, a cash credit account is treated as NPA if it remains, if it is out of order. First point in out of order, outstanding amount in the OD account and cash credit is crossing drawing power. Technically it should not cross, but if it is crossing drawing power, if it is crossing sanction limit, straight away that OD account is treated as out of order. Or, sir, outstanding balance is less than sanction limit, is less than drawing power, but you know, no credits for 90 days continuously. Sometimes in exam they will give you balance sheet. they'll give you balance sheet dates. In exam they'll give you sometimes, just a minute, they'll give you sometimes balance sheet and dates. Okay, so customer is withdrawing, only debits are there, he is not repaying at all, credits not there. So the withdrawals were there, no credits at all. No credits means what? Bank is not receiving any payment. If no credits are there for more than 90 days, if no repayment is there for more than 90 days, automatically, you see, if no repayments are there for more than 90 days, then also the OD account is treated as out of order. Sir, credits are there, sir, repayment is there, but insufficient to cover the interest amount debited. We debited interest, customer repaid, but interest amount also not recovered. More than 90 days, interest amount fully is not paid, then also that is treated as an out of order. Then, so here they have given, here we have given some example. Okay, so what is overdue? Very simple, if an amount is not paid on due date, that's an overdue amount. That's it. So that's about out of order. And remember, NPA classification is always based on record of recovery. Sometimes in exam they'll confuse you. They say bank customer gave 100 crore worth of property asset, he failed to repay the loan, 90 days crossed, but remember 100 crore worth of asset is there, loan amount is just 10 crore, he didn't repay for more than 90 days, but 100 crore worth of asset is there with the bank, doesn't matter. NPA classification is based on recovery. If recovery is not there for more than 90 days, security is there, sir, customer is good, sir, customer is honest, sir, that and all doesn't matter, we will classify it as an NPA, that's it. And if the moment you classify it as an NPA, you need to create provision. So NPA classification is based on record of recovery, not based on security, not based on guarantee, not based on net worth of the borrower. And remember, once a particular loan of a borrower is classified as NPA, remaining loans of the borrower with the same bank will also be classified as an NPA. Suppose mine is a State Bank of India. I gave 5 loans to a customer. Housing loan became NPA. Remaining 4 loans also becomes NPA. Sir, he has a loan with ICICI Bank also. For ICICI Bank, he is repaying everything on time. That will also become NPA? No. With the same bank where one of the loan became NPA, remaining loans became NPA. With other bank, it will not affect. With other, see, every bank has to decide NPA on their own. That's it. That's it. Next, further, the moment a loan became an NPA, it has to be classified under substandard doubtful loss. Substandard means what? It is NPA for less than 12 months. Up to 12 months, no. Once 90 days crossed, it's an NPA. 91st day onwards, that itself is first day again. So up to 12 months, it is treated as substandard. On a substandard asset, provision has to be created on outstanding amount. 15% provision is required. Secured, unsecured portion, doesn't matter. Straight away 15% provision. Doubtful asset. Assets which are in substandard, suppose already NPA over, 12 months over. After NPA, 12 months over, then it will go into doubtful category. The moment it goes to doubtful category, unsecured portion of the loan 100% advance, secured portion we will classify into D1, D2, D3. First 1 year after substandard category, after substandard after 1 year, D1, 25% secured. 1 to 2 years, 1 to 3 years, 40%. Beyond 3 years, 100%. Suppose if the asset is treated as loss asset, okay, and not fully written off in the bank, then 100% provision you can maintain. That's it. A loss asset, no, they either they can create 100% provision or they will write off completely. Any of it can be done. That's it. 1 minute. Yeah, that's it. I hope everything is clear. Next. Now, this is one standard NPA norm. That is normal NPA norm. Normal NPA norm is what? Term loan more than 90 days overdue, bills purchased more than 90 days, credit, cash credit and overdraft out of order. These are the cases. Apart from this, there are some special NPA norms. What are the special NPA norms? Accounts regularized at the balance sheet date, near balance sheet date. Means actually during the year it became NPA. But again customer repaid by 31st March. Now again it became NPA. If at all, you know what happens, in some banks, no, customer will repay before 31st March. Again after March, no, he will withdraw money. Oh, just to remove NPA logic, just to make sure there is no NPAs on 31st March, customer repay temporarily, again he withdrawn later. If at all you think it is something a bank manipulation, you will treat it as NPA even though there is a repayment. So these are the accounts where credits were there just before balance sheet date. You know, these accounts asset classification of these kind of accounts, no, be handled with care. If data indicates weakness, the account is treated as NPA. And the auditor shall check sample transactions before and after closing of the year. And if credits are reversed during the first few days after closing, so after 31st March it became regular, again later on the payments are reversed. It's an inherent weakness, straight away we will classify it as NPA. government guaranteed advances. Government guaranteed advances are two types: central government guaranteed advance, state government guaranteed advance. State government guaranteed advance, straight away NPA. If there is a overdue for more than 90 days, straight away NPA. Principal amount to NPA, interest and all we will not recognize. See, what is the consequence of NPA? Suppose if a loan is given, a loan is treated as NPA. What is the consequence of treating a loan as an NPA? Very simple. We will create a provision on the outstanding amount. That is one consequence. Two, interest on that amount, interest on that loan, bank will not recognize on accrual basis. Once the loan became NPA, on that loan, interest income is not recognized on accrual. You know, banks will recognize accrual. Banks follow accrual basis for income recognition, expense recognition, all that. Accrual means what? The moment month over, they will recognize the income. The moment 31st March comes, full year interest they will recognize, whether you repay or not. That is called accrual. But if the loan is NPA and NPA, interest amount they cannot recognize on accrual unless customer repays. Now, central government guaranteed advance. So that is state government. Normal treatment. For central government guaranteed advance, no, advances are treated as standard asset. Sir, actually there is a default. More than 90 days is there. Default is there. More than 90 days gone. More than 90 days is there. Default is there. Still it is treated as a standard asset only. If the guarantee is not repudiated, not revoked, means not invoked or not repudiated, means not cancelled. Very simple. However, for income recognition, it is treated as NPA. Central government guaranteed advance, principal outstanding, it is treated as standard asset, no provisioning. Whereas for interest recognition point of view, it is treated as NPA, means we will not recognize interest income. Whereas state government guaranteed, no, it is straight away NPA for principal purpose interest. So principal amount, state government guaranteed advance, if at all it became NPA, provision has to be created at 15%, 25, 40, 100 as the case may be. Interest also we will not recognize. Whereas central government guaranteed advance, we will not create a provision. Even though the loan became NPA, we will not create a provision because central government guarantee is there. However, in both the cases, interest will not be recognized on accrual basis. That's it. Next, advances under consortium. Consortium means what? You know, multiple banks together giving a loan, single loan to a customer. Okay, generally big infrastructure projects and all, consortium loans will be there in infrastructure projects. So loans given by two or more banks jointly by forming a group, that's called consortium. Now the bank which is giving high amount of loan will lead that group, that's called lead bank. You know, in consortium loans also, each bank will get loan recovery from the borrower. So each bank will classify the borrower account based on respective bank recovery. That's it. If borrower remit funds to the lead bank, but lead bank is not transferring to remaining banks, remaining bank will treat the customer account as NPA automatically. So lead bank will compute drawing power and allocate to member banks. Borrower may request lead bank to adjust the drawing power between the banks, all that. Now here they have given computation of drawing power in the ICA book. This method, this format is wrong. ICA has given a wrong format. How to compute drawing power, you know, I will tell you. You know, very important this, even in the recent CA final exam also they have asked drawing power calculation in MCQ. They have asked MCQ. In CA final May 25 exam they have asked. In inter also many times they asked how to calculate drawing power. In exam they will give you stock value, they'll give you debtors value. Okay, they will also give you creditors value. Now stock, sometimes in the stock, no, like total stock value 100 crore. Now they will give you 10 crore worth of stock is obsolete or damage, something they'll give you, which means you should consider only 90 crore. Then they will give you something called debtors. Total debtors is 20 crore. In this, more than 90 days outstanding debtors are some 5 crore. So you should only consider 15 crore. Okay, so inventory, only 90 crore worth of inventory, excluding damaged inventory, absolute, that has to be considered. Debtors, excluding long outstanding, more than 90 days overdue debtors, bank will not consider. So remaining 15 crore, fine. So creditors, let us assume 30 crore creditor is there. Now how to compute the drawing power? Stock is how much? 90 crore minus creditors how much? 30. So creditors means what? See, when you're considering stock, no, when you're calculating drawing power, when you're considering stock, no, only one stock has to be considered. 90 crore is a total stock value, considerable stock value, minus 30 crore outstanding, 60. This is inventory, this is stock. Debtors, 15 crore, correct? 15 crore minus inventory. Bank is creating 30% margin, means they will not give you full value of inventory as a loan, 30% margin. On debtors, no, some 40% margin is there. So balance 42 is equal to 18 is equal to 15 4s are 6. Okay, that's it. So 9 crore. So total drawing power is 51 crore. Like this you need to compute. So very simple, stock value they will give you, from that creditors value reduce, letter of credit value reduce, you will get paid stock value. Out of the paid stock, this is paid stock value. So paid means my own stock. In this my own stock, eliminate the margin, balance amount, you can draw the money. Debtors also, eliminate ineligible debtors, then out of that eliminate margin, then you will get, you know, considerable debtors ultimately. So this much you can withdraw in the form of an OD or cash credit from me, you know, from the bank. So this is how drawing power has to be calculated. Remember this particular format. Okay, next, accounts with erosion in security value. Remember, one of the point why a bank will give is based on the security. And you know what happened now? If realizable value of the security is less than 10% of the outstanding amount, directly the bank will classify that loan as a loss asset and write off. Actually, no, customer is repaying regularly. Customer is repaying regularly. In spite is repaying regularly, bank will treat that loan as a loss asset straight away. When, you know, very simple. You know, outstanding amount 100 crore is there. Security, customer gave a security already long back. The value is 200 crore earlier. But right now the security value is 5 crore. Realizable value of the security is 5 crore, which is less than 10% of the outstanding loan. Are customer is repaying on time, that doesn't matter. Straight away classify that as a loss asset and write off fully. Doubtful. So, you know, erosion refers to destruction in value of the security. So the customer gave some security, that security value itself is gone. That's called erosion. That time how to treat it as loss asset. You will treat that loan as a loss asset if the value of the security is less than 10% of the outstanding loan. Suppose if the value of the security is less than 50% of the previous valuation. Last time we did valued some 6 months before. That time what value is there? Now we did again value. The current value is less than 50% of the last time valuation. Then the loan amount is treated as doubtful and provisioning will be made as per doubtful assets. Next, advances against term deposit NSE KVP. Generally, if a customer is not repaying, if more than 90 days he is not repaying, straight away we will treat as NPA. Correct? Based on record of recovery we will apply. But if the customer gave a security and that security is a term deposit and the security is a national savings certificate or Kisan Vikas Patra, Indra Vikas Patra, that Patras he gave a security, then we will not classify the loan as NPA. Sir, 90 days crossed, sir, overdue crossed more than 90 days. We will not treat it as NPA so long the asset is, so long the loan is secured by them until adequate margin is available. So, which means principal is treated as standard asset, interest also recognized on accrual basis, both. Remember, central government guaranteed advance. If there is a more than 90 days overdue, principal we will not classify it as an NPA. No provision. But interest point of view we will stop. But if it is a term deposit, NSE, KVP, IVP security, even interest is recognized on accrual basis. Loan is treated as standard asset. So long margin is adequate, we will classify it as standard. Interest also recognized on accrual basis. Next, agricultural advances. There are agricultural advances broadly classified into two types: long duration crop loan, short duration crop loan. Okay, so what is a long duration crop? Crop with a crop season more than 1 year. If a crop has a season for more than 1 year, that's a long duration crop. For example, mango. You know, mango is a long duration crop. Tobacco is a long duration crop. There are many long duration crops. Short duration crop. Vegetables, short duration crops generally. Now, crop season. Crop season means the period up to which harvesting of crops are raised. You know, this crop season is determined by state level bankers committee in each state. In each state, the state level bankers committee will decide crop season. If the crop season is more than 1 year, it's a long duration crop. Remaining crops are simply short duration crop. Now, you gave an agriculture loan. Sir, it's a short duration crop loan I gave, sir, to a farmer, no, who is planting short duration crop. For him, I gave a loan. What is a NPA now? It is treated as NPA if installment is overdue for 2 crop seasons. In a short duration crop, the agricultural advance is treated as NPA if the installment is overdue for 2 crop season. Whereas a long duration crop, it is treated as NPA if the installment is remaining overdue for 1 crop season. That's special NPA norms mostly over. Okay, next, computation of drawing power. What is drawing power? I already told. Drawing power is the limit up to which a firm can withdraw from the working capital loan given. Sanction limit is the limit, the total exposure a bank can take for a particular client. DP is calculated based on security value, whereas sanction limit is based on repayment capacity, which is the maximum loan a bank can give. Rules for DP. Accounts, no. The loan accounts must be less than drawing power and sanction limit. If any account outstanding balance is exceeding drawing power sanction limit, it must be brought to the top management. Drawing power in the working capital account must be covered by proper security. DP must be calculated based on the latest stock statement. That stock statement shall not be older than 3 months. If there is an outstanding loan where stock statement is older than 3 months, then the account is treated as irregular. Irregular means what? NPA. So DP, drawing power computation, must follow guidelines of the bank. Special focus must be given on sundry creditors. I told you, identify paid stock. From the paid stock, eliminate margin. Then only the balance amount is considered for drawing power. So what are the auditor's concerns in drawing power and sanction limit? Verify stock statements, quarter returns, and other borrowers' data. Compare monthly stock statements, all that. Stock audit. Stock audit is required where loan accounts are having funded exposure more than 5 crore. Auditors can recommend stock audit in other cases also. Review stock audit reports during the audit, focusing on valuation of security and calculation of drawing power, all that. In case of consortium lending, stock audit report shall be obtained from lead banker, because lead banker will do stock audit. Audit of advances. In audit of advances, controls you need to verify. Efficacy of advances, efficacy of controls. Controls means what? See that advances are made only after verifying borrower credit worthiness. See whether the bank has a credit worthiness process or not. See necessary documents are executed before disbursing the loan. Compliance with the terms of the sanction. See whether the bank is checking end use of the funds. See whether the bank is maintaining margin. See whether bank is creating a security or not. See that drawing power register is updated on a monthly basis. Accounts should stay within the drawing power. Irregular account shall be reported to controlling authorities. Review each advance account once in a year or more frequently in case of large advances. Substantive. The auditor can obtain sufficient appropriate procedure by verifying recorded loan amount, checking loan documentation, review account operation, ensure security valuation, all that. Then finally we have something called audit of incomes. In audit of incomes, you see here we have completed. Now what are all the points we have completed already in bank audit? Audit of advance, audit reports, all that is completed. NPA norms, special NPA norms completed. DP calculation I have completed. Now audit of income, reversal of income, and expenditure audit. So if this is completed, bank audit is over. 5 marks is yours. Next, generally what audit of income. Bank recognize income on accrual basis unless collection is uncertain. Whereas on NPA, no income is recognized on NPA until it is realized. However, for newly classified NPAs, if at all any loan is recently classified as NPA, if any interest is recognized on accrual but not yet recovered, shall be reversed. Once an account is turning into NPA, unrealized interest is reversed and recorded in some dummy account called memorandum account. Remember, interest on term deposit, interest on loans against term deposits, interest on loans against term deposit, that's the right word, okay, can be recognized on due date as long as adequate margin is existing. Bills purchased and discounted. For any outstanding bills which are purchased, which is outstanding as on 31st March, the discount received shall be apportioned between 2 years. The unexpired discount must be shown under other liabilities. Interest on rediscounted bills should not be netted off from the discount earned. These are all important for MCQs. Bills collection. Bills for collection. Suppose if a customer submitted me bills, I will ask him, you want me to discount or you want me to just collect? Collect, he told me. Then income will be recognized only after actual collection. Branch commission is due and recognized only after the bill is actually collected. Partial recoveries in NPA. In absence of clarity, bank must adopt a consistent policy. Recognize income only when certainty attaches. Ensure that interest is not from any fresh loan given. Reversal of interest on NPA. What is this reversal? If an advance becomes NPA, the entire accrued interest must be reversed. If at all already recognized on accrual basis and not yet recovered, reverse it. Even for government guaranteed advances, interest has to be reversed. Fees, commission, everything has to be reversed. For wrongly recognized income, reverse the amount to provide equal or make a provision. And remaining, take out finance. This itself can be asked as a 3-mark question. What is take out finance? Originally, one bank will give a loan. Now that loan will be taken over by another bank. Means the customer will transfer that loan from previous bank to this bank. That is called take out finance. A take out finance replaces an initial loan with a long-term financing. This is generally used in property developments, infrastructure projects. That is also classified as NPA. Income should be recognized only when realized from borrower. So what is the objective of take over finance? Address sectorial gap, boost availability of long-term firms, all that. That's a very simple thing. Audit of expenses. In expense audit, no, interest expenditure is most important. Interest expenditure on deposits, FDs, savings deposit, all that will be the rate. So that is the interest expenditure for the bank. Get a quarterly analysis of deposits and compute weighted average interest. Compare average interest rate with previous years. Obtain general ledger breakup of interest. Perform monthly or quarterly cost analysis and document various reasons. Sometimes they'll ask you analytical procedures on interest audit. 1, 2, 4. These 3 points only they'll ask you. And further, auditor has to test check calculations. This itself they can ask you for a 4 marks question. So interest calculations, test check has to be the auditor has to perform test check of calculation of interest. What? See that interest is provided on all FDs up to balance sheet date. Rates comply with bank regulations, RBI directives. Interest on savings accounts follow as per the bank rules. Interest on interbranch is provided. And also see interest rate changes as per the rate card. And recompute the interest accrual by considering various parameters. Audit of provisions and contingencies is one of the exams they have asked this. That's it. I think this is not a big deal. Provisions means what? See, understand bank's provisioning process for standard assets and non-performing. Verify loan classification correctly done or not. Reconcile loan classification with various general ledger. Audit tax provisions also. Review for provision for various other expenses, all that. See that provision is calculated as per regulatory requirements and as per RBI circulars, all that. That's it. Actually, up to NPA norms is there, that is only critical part. So that we have understood with a very clear discussion. That's it. 46 minutes bank audit is over. I hope you have thoroughly recollected everything in the bank audit. Apart from this, is there any other important question? One question is there. I'll show you one more question. Risk management process in a bank. Risk management in a process. This is also important. Once in one of the attempts it was asked in old scheme. So bank must have, top management must involve. Bank must identify the risk. Bank must implement various control activities like segregation of duty, all that. Banks must regularly check their monitoring activities. Bank shall maintain reliable information system. These are all part of risk management process. These are nothing but 5 control 5 elements of control system. Internal control system has 5 components, right? That only here they named it in a different way. That's it. Okay, this itself was asked as once as a 4 marks question previously, long ago. That's it. There is no other question which is important in bank audit. Everything is covered. Everything is covered. That's it. So I hope you thoroughly enjoyed with the bank audit session. Okay, yeah, we'll continue tomorrow the remaining live sessions. That's it. Take care.